Everybody, it's Peter Schiff. It is Tuesday, October 19th, 2010. Well, it wasn't exactly a repeat of October 19th, 1987, but we did have a pretty volatile day in the stock market, the currency markets, precious metals. The Dow was down better than 200 points intraday. I think it closed down 165, but far more action in commodities and currencies. Gold tumbled $40 an ounce today. Silver was down by more than $1. The dollar index surged by about 1 1/3 points across the board. You had a strength in the dollar. Oil dropped by almost $4 a barrel. Now, what was the catalyst for all this? Well, we had a surprise rate hike early this morning before the U.S. market opened out of China. They raised their deposit rate from 2.25% to 2.5%. Now, what actually happened today in the currency market was not a strong US dollar, it was a strong Chinese RMB. Because of the tighter monetary policy in China, the RMB rallied significantly across the board against other currencies. Now, since the dollar is pegged to the RMB, the US dollar basically went along for the ride. But ultimately, higher interest rates in China are not bullish for the US dollar. They're bullish for the RMB, but they are bearish for the dollar because it's going to put more upward pressure on the RMB and more pressure on China to loosen its dollar peg. Because remember, as interest rates rise on RMB, it makes sense for people or hedge funds to borrow in US dollars and then turn around and buy RMB for the positive carry. Because remember, it's basically a risk-free trade because the Chinese RMB is not going to go down. It's either going to stay the same or go up. In fact, the only question in people's mind is how quickly will it rise and how much will it rise? So if you can earn this positive carry by owning RMB and borrowing dollars, more and more money is going to flow into that trade, and that puts more pressure on the RMB. Also, one of the reasons that gold tumbled is obviously a stronger dollar, negative for gold. But any increase in interest rates competes with gold. Because remember, the opportunity cost of owning gold is the interest that you give up. And if the Chinese are offering more interest, then maybe it makes gold somewhat less attractive. But of course, once you actually look at this more carefully, inflation in China is well above 2.5%. Even their own official inflation estimates show a CPI at annual increasing about 3.5%. So even at 2.5%, the interest on deposits in China is still negative. You have a negative real rate of interest. So that is a very positive environment for gold, because if you're going to lose value on your deposits, if a year from now your deposits will be worth less than they are today, there is no opportunity cost to gold, and it's a powerful incentive for the Chinese and other people to be moving into gold. So I don't look at this rally in the dollar or this drop in gold today as any kind of change in trend. It is simply a knee-jerk reaction to tighter monetary policy out of China, and also to a lesser extent, if people are worried about the Chinese economy slowing down due to tighter monetary policy, whenever you see that happen, you get liquidation across the board of what people perceive to be the risky assets, which are stocks, commodities, foreign currencies, and everybody piles into what is perceived as the safe asset, the US dollar. Of course, perception is not always reality, and anybody who thinks the dollar is safe is going to have a rude awakening. But in any event, I think today's action is certainly a positive from the point of view of people who want to put money to work in precious metals, or who are looking to get rid of dollars. You have an opportunity to sell on the strength. And of course, as is always typical with a bull market, you always have more violent moves down than up. The biggest moves have always been at the downside over the last 10 years in this gold market rally, and this one is no exception. These violent moves are designed to frighten people, to get them to think that the bull market is over, to shake out the weak players. The saying is that the bull market takes the stairs up and the elevator down, and that's what's happening. In a bear market, it's the opposite. The biggest days are the up days, right? And it creates a false sense of hope, where a bear market slides the slope of hope. Gold is certainly climbing a wall of worry. In fact, if you look at the weakness today in gold stocks were significantly weaker than the price of gold itself. The HUI index, the HUI, is all the way back down to where it was on on August 31st. And back then, gold was $80 an ounce lower than it is today. So gold stocks have surrendered all of their gains for the last $80 increase in the price of gold. And in fact, if you want to take it back further, the Huey index is trading at the same level today it traded at in November of 2009 when gold prices were $300 an ounce, lower than they are right now. So again, in my mind, the fact that gold stocks are so underperforming the price of gold, again, is evidence to me that there is not a lot of speculation in this market. We're nowhere near a bubble because you have so much fear in the gold market, in the gold stock market. Everybody is waiting for the gold price to fall, so money is reluctantly moving into gold stocks. It only moves into gold stocks very cautiously as the price of gold moves up significantly. You know, also there was another statement today I think it came out yesterday. There was an interview with Treasury Secretary Geithner, and Geithner basically tried to reiterate his own version of the strong dollar policy, saying that the United States is not going to try to devalue its way to prosperity, that we, believe in a strong dollar. And that kind of set a positive tone to the dollar even before we got the news out of China. But of course, the idea that that the U.S. has a strong dollar policy is absurd. I mean, if we have a strong dollar policy, it's in name only. It's not in action. I've used the analogy many times, but it's like a student telling his parents that he has a straight A policy. Well, that might be his policy, but if he doesn't study, if he cuts class and smokes dope, it doesn't matter that he's got a straight A policy. He's got an F attitude, and he's going to flunk his courses. So we can have a strong dollar policy all we want, but if we run big deficits, if we have 0% interest rates and do quantitative easing, and if we have all this regulation and all this government spending and all these taxes, it doesn't matter what kind of policy we have. We're going to have a weak dollar because the weak dollar results from our actions, right? Not from the words coming out of the Secretary of the Treasury. But it's amazing to me that they still have they can even mention that the strong dollar policy. It's so obviously ridiculous. Now, speaking again about things that are ridiculous, I happened to be watching Ken Fisher today. He was interviewed on CNBC. And Ken Fisher, Fisher Investments, very successful money manager, but doesn't know very much at all about economics. He expressed today that he wasn't concerned at all about the enormity of our national debt because, according to Ken Fisher, the cost of servicing that debt is very low. And since the cost of servicing it is low, he's not concerned. Well, of course, the reason that the cost of servicing the debt is very low is because we got it all financed with Treasury bills. The government is spending about 1.5% interest on this enormous debt, but the government is not locking in these low rates. The government is financing its borrowing the way many Americans who bought real estate financed it, using a teaser rate on a loan. And yes, it's not a big deal now. We can afford the interest, but what happens when interest rates rise? Ken Fisher completely ignores the possibility that interest rates could ever rise, or the profound impact that higher interest rates would actually have on the government's ability to service that debt. And also I wanted to point out too some of the protests that we're seeing now over in France to give you an idea of what's to come here in the United States. You're getting these massive protests on the part of the French because the French government is asking French people to delay their retirement because the whole system is insolvent, to delay it to 2 years instead of retiring at 60 to retire at 62. And they're rioting in the streets. It's very violent. Of course, I think they're missing an opportunity. I think the fact that they're protesting shows that they're doing something right. But why not? If they're going to protest, why not do something more significant, like raise it to 65 and do it sooner, rather than I think it's supposed to take effect 5 years from now or something like that. But all of this is what's in store for the United States. The fact that we're not getting any kind of protests shows that we still haven't even begun to address our problems. Our politicians are still making empty promises that American taxpayers can't keep. And the reason we're able to get away with it is because interest rates remain so low, because countries like China are still committed to artificially propping up our currency and buying our bonds. But our day of reckoning is coming, and it's coming soon. And if we want to get a little idea of what it'll look like, take a look at what's happening in France right now. I think it's going to be worse here. Take care, everybody.